Hello and welcome to the second episode of Estate Guru podcast series called Talking Real Estate. Guess what are we going to be doing? We're going to be having real conversations about real estate. And our guest today is Ardi Roosimaa from Estate. Hello, Ardi. Nice to have you.
Hi. Nice to be here.
So, a little bit about this podcast. This is going to be a purely international podcast. So we're going to have people from multiple countries tuning in. So for those of you who don't know who you are, because you're quite famous in Estonia, but for our viewers in Germany, Finland, Latvia, Lithuania, can you please talk a little bit about who are you and why exactly are you famous in Estonia?
Yeah. Well, I have no idea why I'm famous in Estonia, but I'm Ardi. I come from Thailand. I've been in real estate for a couple of decades, and mostly in consultancy. Now, last year is more in development of commercial real estate. So that's my bread and butter.
Excellent. So the topic we wanted to discuss today are the similarities between 2008 and 2023. I vividly remember myself in 2008. I was just finishing my master's in the University of Aberdeen. So I passed this crisis with flashing colors. I literally had nothing, so I didn't have anything to lose. But a lot of people did, and they did. What happened to you?
Well, it was painful to everybody. So I got my hit afterwards, but looking back at it, it was more like a learning curve. The economy real estate economy actually needed some kind of change, because before that, the common taking was that the market's going to grow forever, and there's not going to be any changes, because clearly, we are coming from something from nowhere and being compared constantly with the average of whatever in Europe or Scandinavia. We had a very long path to go, and all of a sudden it all collapsed because we didn't realize that in a course of a way we had overfinanced ourselves, looking good on Excel, forgetting that real money matters, and you can be Excel rich and cash poor, and that's exactly what happened then.
So what do you think had happened in Estonia, and why were the effects so severe precisely for the Baltic market?
Yeah, well, I think the biggest reason for that is the size of the market. It's a very small market, and it reacts very drastically in all the changes, but it also recovers fast. First, at least in Estonia, we can't say the same thing about Latvia, unfortunately, because it took them very long time to recover. I don't know if they really recovered by now, but for our market, it was a quick, really bad happening. The markets basically lost their values. I know portfolios which were back then worth 10 times more than after the crisis. So it was drastic, and the bank lending was much more liberal. You could get money even more than the value of your property. So it was very, very different from the world where we're living right now.
So was it because of the immaturity of the market?
Yeah, clearly. It was emerging market in terms of real estate, and I think maybe we still are right now, but back then it was clearly the signs. Everybody was overly optimistic then, and then when all it happened in a broad base, and obviously it was a financial crisis, which meant everything built on finances was just wiped away, and banks had a lot to do with it, because it started with the banks, and then banks started to take over the properties, trying to save themselves, just completely stopped the lending, and it was harsh. Nothing like we see right now.
But so USA, large market, very mature market, collapse. Estonia, small market, immature market, collapse. But in Finland, small mature market, and there was literally no drop. If you check the housing price index, it didn't indicate any substantial reduction in the costs.
True. From our perspective, it was a little hiccup for them, but even back then, Finland was much better regulated and well watched how it's all happening. The structure of the ownership for homes even is different from ours. So there's not much to compare. And the access to the money, we were still on a further way on a line to get our hands to the money when something comes from starting from the financial centers. It only enters us after the Scandinavia has already taken their toll. So basically, we've seen what the rest of the world, the liberal economies did, the less regulated economies did. Mm-hmm. But then you have Scandinavia, like Sweden, which had a hit, but it was milder because they were financial center, better regulated, and Finland much more regulated than our market.
But I mean, we sort of, shared the same banks. Would you say that, the way they operated in Finland and Sweden was very much different from the way they operated in Estonia and Latvia?
Yeah, quite a lot of bad things happened back then because one of the bad stories, what really happened was that the Swedish banks having a headquarters here really used quite a bit of the money which they collected from the markets to take them back home, which means that for us it completely disappeared, and we were the last ones to get anything. So up from being a very well financed and on a terms almost comparable with Scandinavia, we just lost everything, and the money collected from the market went to the other markets instead of coming back. So that was different. But again, it's something to learn from. It's probably it should show you that you can't be overly optimistic on financing. And for the markets, ever since, it's like 15 years now. It's been a very good call to reason, because we still have very reasonable financing terms, even up into 2020 when everything looked super peachy. So that's completely different.
So a lot of people, they were like, okay, so what do you want from us? Collapse happened in America, and we all live in a globalized world. So when they have a flu and they cough, everybody gets a flu. But if you look at the situation around us, none of the neighbors, they didn't experience the kind of drawbacks us in Estonia did, or people in the USA did. So if you do things correctly in one particular country, you can avoid the negative effects of the globalized economy.
Yeah, absolutely. Well, you're still part of the global economy, and it's a question how much you're tied to in many terms. One thing is financial part. The other thing is the economy overall. How much you're tied to foreign markets for exports, for imports, and how much you are self-sustainable. Well, obviously, back in 2008, we weren't. We were so young. We were not part of Eurozone. We had no backups. So basically, this is where we were, and we looked on the liberal world like something, everything they said was a golden truth. And then we had a lot of cowboys coming over and tried to make a lot of money on these new markets, rapidly growing markets. And they had no emotional ties here. They just draw back the money and went back home, and they made a fortune here. So that was exactly where we were. And now we are, I think, in a way, we are in a situation where they were back then. And we are trying to find the ways to go abroad and make money somewhere on the same growth patterns. And I don't know if it happens somewhere in the world, but definitely there's always emerging markets around the world. We see Estonians go to Africa, whatever. So this is what it was. Many factors. It's not just internal markets or even the financial regulations. It's more like how the foreign markets, foreign investments, how everything starts to work against you or for you.
Would you say that the economic situation in USA is going to be a major factor for us in 2023?
Well, we'll see. Europe has tried to decouple themselves from the US economy for years, trying to make a comparable environment, and it's not really working. So we'll see. Yes, definitely the big money centers. They are still. We have a couple in Europe now. We have UK is not part of European Union anymore, which means there are very strong financial centers outside the European Union, and it's even more struggle for us to be so independent or compatible to all these big centers. So we'll see. But if you look at the Euribor hikes or US Libor hikes, then they are quite similar. And one going rapidly in front of the other. Europe's trying to be more conservative on financial terms, but still we're the idea and the philosophy behind it is pretty much the same. We have to tackle these out of hand growth, which the economy itself created with zero interest on money or whatever it might be.
Would you call the current situation right now in the world probably like a recession, or we have just hit the plateau for the time being, just stopped growing so quickly?
Yeah, well, it's always you always want your balloon to go out with a little whiz, not with a big bang, because it's easier to handle. But then the question is, maybe the bang is easier to handle in the long run, that it recovers faster. There's still a lot of belief that economy is going to recover without any drastic changes. If you take the Estonian situation, and I think when we talk about real estate, then it's about the access to really have one, to have a capability of buying. The purchasing power has grown in the long run in pair with CPI growth. So we'll see. We're pretty good situations there. The salary growth is still growing on, which we didn't see back in 2008. We talk about then the salaries dipped by something like 20-30%, and that was really significant. Plus the unemployment, which we haven't really seen yet. So we know we're. I think we have plateaued, because the economy is now starting to react to the measures taken. But again, then how hard the reaction will be, this is only the future to tell, because we're hit from 0 to 4 or 5, whatever, drastically speaking, on financing terms. Then it'll have effect in a year, one and a half or so. So we'll see next year. We'll see this autumn what's going to happen to the markets, but there has been a lot of things which have worked parallelly to stabilize the situation. I mean, the financing terms started to go more strict even before it all happened. We had notifications to take down the speed. We have been carrying through all these really good times, very solid levels of the financing, the equity requirements on financing. It's never been to zero like it was before the first crisis, and very, very hard risk analysis. We have Basel is going 2, 3, 4, 5. It's even from the bank's perspective in financial markets, it's so much different, and the speed has been taken down gradually. And then the developers, we have seen a lot more professional developers than we saw back then. They weren't more cautious, seeing these signs. So the supply has declined a little bit, which means it goes in pair with the demand. Demand drops off rapidly and the supply continues like in 2008. Then it's a collapse and the prices will be just falling like stones. Not this case. We are holding up quite well, and there are structural reasons for that. So I think we're in much better place than we were back then.
Now, a lot of people, when they comment on it, they say that the generals are always preparing for the war that was in the past, and we learn our lessons from 2008. We're not repeating the same mistakes, not leveraging ourselves when it comes to mortgages. I think that there's less gambling going on derivatives right now that are tied to those securities. But aren't you afraid there's going to be something brand new, entirely a new pitfall that will manifest itself and will bring down the entire system, just like it did in 2008.
If I only had a crystal ball. But there's, talking about generals, there's only so much generals, and then there's the rest of the guys. So I think it might hit us from the other sides, but if you take your analytic thoughts and you think about where it could come, and then there are some structural things which might go wrong. The only thing I could point out right now is there is a rally of financing in a startup industry, which has been carried through the last 10 years, and in completely not understandable basis of promises of doubling or tripling or whatever, 10 times making your money, which always is more like a lecture of frauds. So we see the efficiency of this segment of the industry hasn't reached up. So definitely there is some room to lose some money. I think it's already happening because returns are not what they were supposed to be. And the question is now, how strong is this digitalization, automation thing in a broader terms to sustain these things? It's just, okay, investors will lose their money, but they will probably use the profits first and then have another view what's happening. So this is a segment where I've seen through all these last years where the money has been thrown at people instead of being reasonably calculated on a basic terms, on some real calculations. So this is where it might come from, but it's just one part of the economy, and it's probably not that significant that it could make a serious dent on a broader picture. So we'll see. It's just an idea.
So you don't think that Estonian tech sector and its rapid growth in the past decade, if it's repriced, if a correction, a major one happens to this sector, we're talking about, a huge reduction in the price of commercial real estate. A lot of people who have earned money in this sector has actually reinvested it into the real estate market. If this sector experiences a major correction, do you think it's going to have a major impact on the price of real estate in Estonia?
Well, it might, but the real estate sector always has two speeds. There is this very emotional, very rapidly changing market of residential real estate, which is making about 70% of the whole market. And then there's this more stable, Excel-based commercial market thing, which is much more sustainable for any kind of crisis, and it never really reacts so strongly like the residential segment, because residential, obviously, we have a lot of people who are not professional doing their things and they just do it emotionally. Whereas in commercial real estate, everybody knows Excel, so to say, and all the calculations are done on real values of running rents, whatever it might be. So this is where first we have to look. Still, whatever happens, we have to look at the residential market, because it's going to react fast. It's going to be whether it disappears, whether people thinking about the future of their capability of servicing the loans, because it's usually built on loans, and then only after that we'll see. The other side of the story is when the profitability of the commercial entities starts to deteriorate, which is happening right now because all the inputs are growing very fast. Then what's going to happen with the sustainability of the end users of the commercial real estate? Because the supply there is always much more stable, and it's calculated. But then even the long run, even the large companies can disappear for the very small reasons, when it piles up over the years and years. So this is where I see the commercial market still stabilizing a lot, but there's not I would say there's not accidental money on commercial real estate. It's more like planned and seen, because it gives you lesser returns, I mean, in the short run, and it needs to be understood properly to invest to, and the ladder or the level of the first investment obviously is much higher than in residential. So residential market is the one which we should watch to see the first signs of decline. We see right now the activity on the market on residential has really gone down. It's still there. It's not, stone bottom, but we see some changes. Obviously, it's not a good time to talk because we only have figures from the start of the year, which is always a little bit weaker than the rest of the year. But the activity of Tallinn, which is the biggest part of the resi market, has been lower than it has been for the last 5-6 years. So we'll see whether it recovers.
Well, I mean, over the past 5-6 years, it's been literally insane. I mean, when I was purchasing an apartment, I had to make an offer. The same day, I viewed the apartment for half an hour. That was just a reality. Yeah. So if right now, people can take like 7 days to consider, and they're like, oh, it seems like the market is really slowing down. You can now wait for 7 days. You can haggle a little bit, but it's not really an indicator of any demise.
Well, it's a strong boom signs. Yes, it's always been emotional, because why I'm laughing is because in commercial real estate, the due diligences, all the transactions on the analysis you run on an investment, it might take you not 7 days but 7 months. So you really have time to reconsider everything when the big international investors make their investments, which are massive, then obviously it takes a lot of time, and then intentionally so. You have a big teams working on everything, calculating every single risk, including starting with the financial and then the technical. Maybe it falls down the building before you even move in. But in resi, I think there are always so to say some cherries on the market which you want to pick, and then you really have to be fast, and as the purchasing power really grew very, very fast before it all happened, then people were looking more and more into possibility of investing into good properties, and there's only so much good properties when you look at the location and the price, and long run sustainability, the energy consumption. There was always these ones will always be liquid and always be something that move fast. So yeah, this is you can't tell if this you have 6 hours or you have 6 weeks, whether it really says something about the market. It says something about this particular product. That's the case. But then bringing it to the real life right now, then if you talk about residential investments, then investments tend to be in resi, they tend to be necessary. So you probably have some kind of need, and it's usually not parking your money. It's usually maybe growth of family, whatever, moving from the parents. It's something real which you can't really push forward too long. So thinking about that, you could make a good speculative property returns on these conditions. It's not real, because if your apartment is super expensive and you sell it, anything you buy from the market is super expensive at the same time too. When your apartment is cheap because of the economy, then obviously you buy something cheap as well. So it's always parallel, and you shouldn't think this much of making money on speculation on different products, but more like in a long run, how much the value of your investment will grow, or your home, which should never be looked at the investment. It's more a necessity.
Oh, so we've been kind of circling the question. I think the only question our audience is really, really interested in. Your opinion: is it a good time right now to invest into real estate? Yes or no?
It's definitely not an easy time.
It's never an easy time.
Yeah. Well,
It wasn't easy 2 years ago and 4 years ago.
yeah.
Everyone was buying apartments at the all-time high, but the all-time high would shift every year.
Yeah.
But right now, what do you think?
Yes, it's a good time to invest into real estate because you're going to sustain your investment for a longer run. You're gonna save your money, and the history has proved over and over again that in a long run, property gives you returns. Even if the market goes, the other way, then you still have your at least 5% value growth, capital growth in real estate. So it's a safe haven, and it's always been there. And yes, the economy is changing, and you always have to value your capability of servicing the financing you're taking. Maybe you're overly optimistic about taking credit. And then when the crisis happens, you're going to be in a pickle because you can't service the interest. And this is, the biggest question for the homes, because, if you buy on a very expensive time and your bank has been very generous with the money, then obviously the monthly expenses for a family are very high. And now the question is your salary going to be in par of growing expenses? The salary growth has also been in double digits, so it's leveled out, and couple of percents in a growth of the interest of your home loan shouldn't be a big problem if you have done it on a reasonable way. If you had an additional collaterals with your parents' apartments and you financed 90% of your home, you might be in problem, but we're looking at 3 years of your life, whereas as you probably own your apartment maybe 10 years and it's going to be recovering. So I think, real estate is always a good thing to invest. If your ambition to make money on the investments is higher, you should find something else to do. Do something productive in an industry, or go IT or automation and digitation. So you can find other ways to make more money in a short term with much higher risks, but real estate is something which brings back your value and sustains it. And that's something which has grown the overall wealth of Estonians through all these 30 years. And will continue to do so.
Okay, so we're talking about personal real estate right now. But is it a good idea to invest into real estate-backed loans, for instance?
Yeah. Again, might be, whatever it might be. It can be real estate-based loans. The big difference is whether you do direct investment or you go into instruments, whatever they go. Real estate-backed loans, bonds, whatever you do. The biggest difference is that on a base property, you're going to index your investment or your cash flow yearly. That's quite common practice. If not, then it's a bad agreement on there. But basically, this is where you look at it. And when you go into the loans, then you are tied to the interest you're offered. The bonds are pretty much the same. In a long run, if you talk about years, 5 years, 10 years, whatever the closing time is, then basically you could multiply your money on indexing, which is on a base property. But another question is whether you have enough money to put your investments into the commercial property, and then obviously the ladder is much higher. So that's the big question. I would say if you have time to understand what real estate is, be direct, invest into the underlying property. If you believe in a thing but can't really spend time much, or you trust somebody else like a staker, then it's an easy thing because that collateral behind this financial instrument you're basically investing in is backed with something you really believe in. So I think that's the key answer to that.
All right. Mm-hmm. What advice would you give to all aspiring investors who are watching us right now? Trying to learn from the best, trying to learn from professionals.
it's very difficult to give advices when it comes to investing because you always have to have a disclaimer. But I think we're moving in a very turbulent environment right now. We don't know what's going to happen to the autumn. Yes, we have first signs that the CPI and the crazy growth of the market will be taken down with a Euribor hikes, basically. Let's name it this way. I don't believe that there's going to be a quick cure, and I don't think bank think it either. So we'll see. If you have access to good terms financing, which is better than returns from your investments, obviously, that you have some return on your equity, then go on and do. That's my advice. Go and invest if you have access to leverage. If you don't have access to leverage, that means somebody else has run the calculations and come to the solution that really it's not a good time to be there.
Well, thank you very much, Ardi.
Thank you.
It's been a pleasure. Guys, if you have any questions following this interview, please don't hesitate to post them into the comment section. We'll try to get the answers for you as well. If you enjoy our content, like and subscribe, or do not. I'm not a beggar. And we'll see you very, very shortly with the third episode of our podcast. Thank you very much, and have a great day.
Thank you. Have a great day.